This is the story of how Wall Street received explicit warnings about an impending market catastrophe and chose to ignore every single one. In 1929, the architect of the Federal Reserve, respected economists, and seasoned investors all predicted a devastating crash months in advance, but the market dismissed them all and paid for it with an 89% collapse that triggered the Great Depression. 7 months before the crash, on March 8, 1929, Paul Warburg issued the clearest alarm anyone could ask for. Warburg wasn't some fringe pessimist making wild predictions from the sidelines. He was the architect of the Federal Reserve System itself and the former vice governor of the Federal Reserve Board. His annual report to stockholders of International Acceptance Bank contained a warning so direct it's almost shocking to read today. If the orgies of unrestrained speculation are permitted to spread, the ultimate collapse is certain not only to affect the speculators themselves, but to bring about a general depression involving the entire country. The New York Times dedicated 2 full columns on its editorial page to his warning, and a brief wave of selling did hit the exchange. National City Bank responded by rushing $25 million in cash to the call money market to ease the panic, literally papering over the warning so the party could continue. A month before Warburg's warning, the Federal Reserve itself had already tried sounding the alarm. On February 2, 1929, the Federal Reserve Board issued a formal letter to all reserve banks making their position crystal clear. The Federal Reserve Act does not, in the opinion of the Federal Reserve Board, contemplate the use of the resources of the Federal Reserve Banks for the creation or extension of speculative credit. Their letter specifically called out the extraordinary absorption of funds in speculative security loans, which has characterized the credit movement during the past year or more, which was their polite way of saying the market had gone completely insane. But here's the thing, the Fed couldn't agree on how to stop it. The board wanted to deny credit directly to banks that were fueling speculation through what they called direct action, while the New York Fed pushed for raising interest rates instead. While they argued about methodology through the spring and summer, the speculation continued unchecked until August of 1929, and by then it was far too late. Roger Babson delivered the next warning on September 5, 1929, speaking at the annual National Business Conference in Massachusetts. What he said was so specific, it's almost haunting to read today. More people are borrowing and speculating today than ever in our history. Sooner or later, a crash is coming, and it may be terrific. The vicious circle will get in full swing, and the result will be a serious business depression. There may be a stampede for selling, which will exceed anything that the stock exchange has ever witnessed. Wise are those investors who now get out of debt and reef their sails. The market dropped about 3% that afternoon in what became known as the Babson break, and Wall Street absolutely turned on him for it. The Chicago Tribune published numerous rebuffs from economists and business leaders who attacked his credibility, and critics went so far as to question his patriotism for making such an un-American projection. Warning people about financial danger had somehow become an act of disloyalty to the country. A handful of smart investors were quietly listening to these warnings while everyone else shouted them down. Baruch, known as the Lone Wolf of Wall Street, had already started selling his positions back in 1927 after watching the Florida real estate bubble collapse taught him what euphoria looks like right before it ends. When someone offered him participation in 2 new investment trusts called Shenandoah and Blue Ridge in August of 1929, his response captured his view perfectly. The formation of these companies looks like financial whoopee. He refused to join a bull pool on September 25, 1929, and had moved most of his holdings into cash before the crash arrived. Years later, Baruch wrote something that perfectly captured the insanity of the moment. Taxi drivers told you what to buy. The shoeshine boy could give you a summary of the day's financial news. An old beggar who regularly patrolled the street in front of my office now gave me tips. When shoeshine boys start giving stock advice, the top is in. Joseph Kennedy reportedly sold his entire portfolio after receiving stock tips from a shoeshine boy. Though that particular story might be apocryphal since it first appears in a 1965 biography, what we do know for certain is that Kennedy's timing was impeccable, and he went from approximately $4 million in 1929 to over $100 million by 1935. For every investor who heeded these warnings, dozens more shouted them down with increasing confidence as prices kept climbing. Nobody shouted louder than the optimists who would soon lose everything they owned. Irving Fisher stood at the top of that list, one of the most brilliant economists in America, a Yale professor, a pioneer in mathematical economics whose theories are still taught today. Fisher had the credentials to influence millions of investors with his opinions. On September 6, 1929, the day after Babson's warning sent the market down 3%. Fisher publicly dismissed the concerns. There may be a recession in stock prices, but not anything in the nature of a crash. 9 days before Black Thursday, on October 15, 1929, Fisher told the Purchasing Agents Association something that would haunt him for the rest of his life. Stock prices have reached what looks like a permanently high plateau. I expect to see the stock market a good deal higher than it is today within a few months. Those words became the most infamous market prediction in American history, and Fisher wasn't finished doubling down on his optimism. On October 21st, as cracks were starting to show in the market, he dismissed the selling as only shaking out of the lunatic fringe, and on October 23rd, he insisted that security values in most instances were not inflated. The crash wiped out Fisher's entire fortune, which had been estimated at $10 million. He borrowed $750,000 from his sister-in-law trying to cover his losses, had to sell his home to Yale in 1936, and never recovered financially or professionally from being so spectacularly wrong at the worst possible moment. Charles Mitchell might have been even more relentless in his optimism than Fisher was. As president of National City Bank, which we now know as Citibank, and the director of the Federal Reserve Bank of New York, Mitchell earned the nickname Sunshine Charlie for his unfailing cheerfulness about market conditions. On March 26, 1929, in open defiance of the Federal Reserve's warnings, he announced $25 million in margin loans with this justification: "We have an obligation which is paramount to any Federal Reserve warning." Throughout October, as the market began falling apart around him, Mitchell kept reassuring anyone who would listen that everything was fine. October 1st brought this statement: "There is nothing to worry about in the financial situation in the United States." October 8th, "Nothing can arrest the upward movement in the United States." October 15th, "The markets generally are now in a healthy condition." October 22nd, with the market clearly in trouble, "The decline has gone too far. The situation is one which will correct itself." Senator Carter Glass later put the blame squarely on Mitchell's shoulders. He, more than any 50 men, is responsible for this stock crash. So why were so many intelligent people so catastrophically wrong about what was coming? The numbers seem to justify believing in a new reality where old rules no longer applied. From August 1921 to September 3, 1929, the Dow had climbed from 63 to 381.17, roughly a 500% gain over 8 years. Just in the last 90 days before the peak, the market had gained 27%, and everyone could point to genuine technological advances like radio and automobiles to explain why this boom was different from all the others. The foundation underneath all those gains was rotting away where most people chose not to look. Investors could buy stocks with just 10% down, which meant your 10% cash deposit let you control stocks worth 10 times what you actually had. A 10% market drop would wipe you out completely and trigger margin calls that would force you to sell, pushing prices down further. Broker loans outstanding had reached somewhere between $6.55 and $8.5 billion by September of 1929, which was more than all the currency in circulation in the entire United States at that time. By midsummer of 1929, about 300 million shares were being held on margin, and margin loans were increasing by approximately $400 million per month. The leverage was astronomical, visible to anyone who looked at the numbers honestly, and the warnings about it weren't subtle or cryptic. They were explicit, public, and delivered by people who understood exactly how dangerous the situation had become. But prices kept rising, so the warnings kept getting dismissed as pessimism from people who didn't understand the new era. September 3rd, 1929 marked the peak when the Dow hit 381.17. 2 days later came Babson's warning, and the market drifted lower through September and into early October. Between October 18th and 23rd, the market entered what traders called free fall, and on October 23rd alone, the market lost 6.3%, with 2.6 million shares changing hands in just the final hour of trading. Black Thursday arrived on October 24, 1929, and opened with complete chaos. Nearly 3 million shares traded in the first minutes alone, and by morning the Dow had crashed from 305.9 down to an intraday low of 272.3, which was an 11% drop before lunch. The ticker tape fell an hour and 40 minutes behind the actual trading, which meant brokers couldn't even tell their clients what prices they were getting, and panic was spreading through every corner of Wall Street. At noon, the leading bankers of Wall Street gathered at JP Morgan headquarters and pledged between $240 and $250 million to support the market and stop the bleeding. At 1:30 in the afternoon, Richard Whitney, the vice president of the New York Stock Exchange, walked dramatically to the US Steel Trading Post and announced loudly enough for everyone to hear, $205 for 10,000 shares, which was $5 above where the stock had been trading moments before. The banker's intervention worked, at least for one day. The market rallied off its lows and the Dow managed to close at 299.5, down only 2.09% despite the morning's carnage. Volume reached 12,194,650 shares, absolutely shattering the previous record of 8.2 million, but most people convinced themselves the worst had passed. The bankers had stepped in and saved the day, just like everyone hoped they would. Monday, October 28th proved everyone wrong. The Dow dropped 38.33 points that day, a 12.82% decline that stood as the largest single-day loss in history at that time. Trading volume hit 9,212,800 shares, while General Electric dropped 47.5 points and AT&T fell 34 points. At 1:10 in the afternoon, word spread that Charles Mitchell had been spotted entering the JP Morgan building, and hopes rose briefly that maybe the bankers would mount another rescue operation. Mitchell hadn't come to organize market support, he'd come to request a personal loan for himself. Black Tuesday hit on October 29, 1929, and became the worst day in stock market history until the crash of 1987. Trading volume reached 16,410,030 shares, a record that wouldn't be broken for nearly 40 years, and the Dow dropped 30.57 points or 11.73% to close at 230.07. The ticker tape ran until 7:45 that night, trying to catch up with all the trades, and when the dust settled, $14 billion in value had evaporated in a single day. Over just the 2 days of Black Monday and Tuesday combined, $30 billion disappeared from the market, which was more than the United States had spent fighting World War I. What most people didn't realize at the time was that the crash had barely started. November 13th brought what looked like a bottom when the market hit 198.60, down 48% from the peak, and then came what traders call a sucker's rally that carried prices back up to 294.07 by April of 1930. That recovery trapped countless investors who thought the worst had passed and bought back in, only to watch their money disappear all over again. The bottom finally arrived on July 8, 1932, when the Dow touched 41.22. From the peak of 381.17 down to 41.22 represented an 89.2% decline, and some individual stocks got destroyed even worse than the averages. RCA fell from $505 all the way down to 2.625 US sized. Steel dropped from 262 to 22 for a 92% loss. General Electric and General Motors each lost 89% of their value, and Deere & Company along with Anaconda Copper each fell 96% from their peaks. The Dow wouldn't recover its 1929 peak until November 23, 1954, which meant investors who bought at the top had to wait 25 years just to break even. Between 1929 and 1933, somewhere between 5,000 and 9,000 banks failed across the country. In 1930 alone, 352 banks collapsed and took $853 million in deposits down with them. And in December of that year, the Bank of the United States failed in what became the largest single bank failure in American history, with over $200 million in deposits simply gone. Unemployment climbed from about 3.7% before the crash to 25% by 1932. Real GDP declined roughly 29 to 30%, industrial production fell 47%, and in 1931 businesses were failing at a rate of 133 per day. Every single warning had been right. Paul Warburg predicted a general depression involving the entire country. Roger Babson said the crash would be terrific and would exceed anything the stock exchange had ever witnessed. The Federal Reserve warned about the extraordinary absorption of funds in speculative credit. All of it came true exactly as they said it would, and yet the market ignored them, not because the warnings were unclear or hidden in technical language, but because Wall Street didn't want to hear what they were saying. When prices are rising, warnings sound like pessimism from people who don't understand the new reality. When everyone around you is getting rich, caution sounds like cowardice or jealousy. When taxi drivers and shoeshine boys are confidently giving stock tips, questioning whether it can continue seems almost un-American. The optimists who lost everything weren't stupid people. Irving Fisher was brilliant, one of the great economic minds of his generation. Charles Mitchell built one of America's largest and most powerful banks. What captured them wasn't ignorance, it was the same forces that blind every generation of investors when markets get out of control. The belief that this time really is different, the social proof that comes from watching prices rise day after day, and the psychological inability to imagine that such broad consensus could be catastrophically wrong. The 1929 crash wasn't a surprise that nobody saw coming. It was a choice to ignore the people who saw it coming and said so publicly with their reputations on the line. The information was available to anyone who wanted to look at it honestly. The warnings were explicit and came from the most credible sources imaginable, and the danger was quantifiable in the margin debt numbers and leverage ratios. Wall Street chose to believe what it wanted to believe right up until the moment $30 billion disappeared in 2 days and the world economy collapsed for a decade. The question we should be asking isn't why nobody saw it coming, because plenty of people did and said so loudly and publicly. The real question is why, when credible experts issued explicit warnings backed by clear evidence, the market refused to listen until it was far too late.